Hey there, I'm Ashley Fields with Fields Accounting Firm, and this video is dedicated to married couples who file their taxes together. So the filing status is considered married filing jointly. Oftentimes, I receive phone calls, emails, and booked tax planner appointments for married couples wanting to understand the tax code and why, when they file their taxes together, they always end up owing at the end of the year. So, I want to show you what that looks like on the tax table so that you can see what your taxable tax rate is. And I'm going to provide you examples on how you can reduce your income. So I am going to share my screen. And this is actually a tax table that was generated when I filed a married couple's tax return for the 2022 tax season. And you'll see here in bold that they are in the income range of $83,550, and the max income was $178,150, and they are being taxed at 22%. But you would see here that the first tax rate is 10%, and you'll see here on the left that the max that a married couple can make to be considered in the 10% tax rate is $20,550. Now, if they make over this $20,550, then this would, of course, put them at the 12% tax rate. The maximum income for the 12% tax rate is $83,550. For this scenario, the client was taxed at 22% because they were in this range of $83,550 with the max of $178,150. Now, let's say when you guys file your taxes this 2023 tax season, and you guys are in a higher tax rate, and you see that 24%. And I will say honestly that none of my clients, making good money is great. But this is where tax strategies come into place, because when you're at this 24% tax rate, when they say this quote, more money, more problems, this is a true statement, a true quote. So the more money you make, the higher taxes that you have to pay. You'll see at this 24%, the max that you can earn before you're pushed into the 32% is $340 and $100. You guys see that? The next tax rate is 32%, and the max that you both can earn is $431,900 at this 32%, and then it increases at 35% with the max income is $67,850, and then the final tax rate, which is 37%, and you see how the max is ... That's because if you make over this $647,850, you're subject to the 37% tax rate regardless of whatever income that you jointly make in excess of the $74,850. So this is what the tax table looks like, and this is how the Internal Revenue Service determines what rate that you will be taxed at when you combine your income on your filed tax returns. For this scenario, these clients were at 22%. Now let's get into the good part. Now that we understand what the tax rate looks like, the income levels, and what pushes you into a higher tax bracket, I'm going to share my screen again, and I'm going to show you what it looks like inside of my tax system and proven strategies on ways to reduce your income that will essentially put you in a lower tax bracket. So let me share my screen here, and then I'm going to share my tax planner. 1 second. 2022, there we go. And we're going to share the screen here. Alrighty. Let me check on my Google Meet for this session here. There we go. Okay. Alrighty. So this is actually a view into my tax system. So when I am filing a married couple's tax return, This is what it looks like in terms of income that I input into the system. So when a client is wanting to reduce their income, one of the ways that you can do so is through a business, but only if that business had a loss, is when you can reduce the overall income. But when there is no loss and there is a profit for the business, all of the income is combined together, okay? Another way that you can reduce your income and avoid any tax obligations during tax season is making estimated tax payments, which is the second tab here. The office and home is associated with your LLC or any contracting income that you've made. Maybe you have business expenses like a car and truck, but the home office, you're able to deduct a percentage of your home expenses, especially if you are a home-based business. That's subject to the square footage and all that good stuff. So you're able to get a percentage back on your taxes for what you spend in rent or mortgage, any type of utilities, HOA fees, management fees, or any type of any additions to your home that you made so that you can run your business out of your home. That's what the office and home deduction is. The auto expense worksheet, that's more associated with the Schedule C. And so you're able to deduct your mileage and or because you can't do both now, the tax code has changed, so you have to either choose between mileage, which is what I recommend because right now it's 65 cents per mile, or you can choose to deduct your car expenses. So maybe you had hefty car expenses, like maybe you had to replace an engine or tires, and it's a better benefit to claim your car expenses versus the mileage. I've rarely have seen that. I definitely recommend that you claim mileage on your tax returns, okay? The oil and gas depletion, that's more so for truckers. I typically and rarely see standard businesses that utilize the Schedule C utilizing the oil and gas depletion worksheet. This is more so for highway trucks, those type of transportation type companies, okay? Moving expenses. If you moved from another state to take on another job, then you can deduct your miles from your old place to your new place. You can also deduct any lodging or any type of moving expenses that were not reimbursed by your employer. Do not make that mistake of claiming expenses that your employer already paid back to you. Now, if you are self-employed and you made a decision to move from another state to another, this is not a tax deduction because the Internal Revenue Service will claim, and this is their mindset in terms of LLCs or self-employed individuals moving from another state. Number one, it's not a requirement that for you to run a business, and the IRS then asks for you to run a business. So this is why this is not a tax deduction if you move your business from one state to the other. So typically, if you accepted another job in another state, or if you are a member of armed forces, then you are able to reduce your overall income when you file together using the moving expenses. But if you don't qualify for those two, then you cannot unfortunately claim the moving expenses. The next one is the IRA. So if you're contributing to your retirement, I'm not talking about any employer-sponsored retirement plans. I'm talking about more so self-employment. So like I mentioned before, for this scenario, the husband works a W-2 job and the wife runs a business. One of the ways that you can reduce your income that may essentially put you in a lower tax bracket is if you contribute to your retirement plan, your self-employment retirement plan. Okay, medical savings account. Everyone should already know what that is. If you're contributing to that account, whatever your contributions were, you can use that to claim that on your taxes, which will essentially may reduce your taxes. Now, there are income thresholds for a lot of these adjustments that I am discussing. So that's why it's important that you book an appointment with your accountant to determine if that you meet a lot of these income limits that I'm talking about, because there are income thresholds, and oftentimes high income married couples, when they file together, they're kind of exempt from a lot of deductions, or you need really hefty, really serious tax strategies that will help reduce your income. A lot of the ways that I see married couples reducing their income is via a business, which is a really great tax strategy, especially if that business was not profitable. But if it is profitable, then of course the net income is subject to self-employment tax, and all of that income is being combined together, and whatever that looks like will determine at what tax rate you're being taxed. Okay. Another one that I did want to go over, I'm not going to necessarily go into the 2018 disaster retirement plan distribution, 2019 disaster retirement plan distributions, because essentially when you come and file your taxes in 2023, it's my opinion that this would all be, these two strategies would be obsolete. But one of the ways my top ways that applies to most married couples is contributing to your retirement plan or your business. So those are my two top recommendations for reducing your income. So let's go to another tab here. This is what the tax planner software looks like. This return does not actually belong to any of my clients. This is just one that I created so that I can give you some tax strategies, okay? So we already went over the adjustments to income here. Itemizing is a really, really great way to reduce your income. So let's go over the Schedule A here. So when you itemize, if all of your combined expenses, such as any out-of-pocket medical expenses, dental expenses, medical miles, if this does not exceed your standard deduction, unfortunately, it won't be accounted for when you file your taxes, because it has to exceed your standard deduction of $25,800 when you file your taxes together. But if everything, your medical expenses, dental expenses, medical miles, any gifts to charity, even non-cash gifts to charity, your property taxes, your mortgage interest, your car tax fees, if all of that combined does not exceed your standard deduction, then unfortunately this won't be accounted for, and the system is automatically going to give you your your standard deduction, because this is a better tax benefit for your taxes. But if all of your expenses combined when you're itemizing exceeds your $25,800 standard deduction limit, then this is a really great way to reduce your income that may essentially put you in a lower tax bracket. So let's recap. 3 ways to reduce your income is through running a business, because you get to deduct all of your expenses, all of your car and truck expenses, and then if you're home-based business, then you're able to deduct your home office expenses as well. Another way is if you moved from another state to take on another job, or if you are a member of armed forces, then that is a way to reduce your adjustable income that would essentially put you in a lower tax bracket. Contributing to your retirement plan, especially if you are self-employed. Like I mentioned before, this does not include any employer-sponsored retirement plans. You can't claim that on your taxes. That's actually called double reporting. And I don't want you to make that mistake, because this can trigger an audit. And when you can't prove When you cannot prove any expenses or anything that you've claimed on your tax return, then the Internal Revenue Service, including the state, will make that adjustment. And whatever that difference is, you'll just have to pay that back to your state. We talked about the medical savings account, your HSA, which is the health savings account, is a great way to reduce and adjust your income. That would essentially put you in a lower tax bracket. And then last would be itemizing. So if you had out-of-pocket medical expenses, and any gifts to charity, you own a home, so you pay mortgage interest. You have property taxes that you've paid for the tax year. Any car expenses such as the tag, you're able to itemize that. But if it does not exceed your standard deduction, then your tax software is going to automatically give you the standard deduction, because this is a better tax scenario. So I hope all of this information helped. I'm going to switch back to, there we go. So I hope all of this information helped. And I hope that I was able to explain why, when you are filing together, you are in a higher tax bracket. It's because you are combining your income. And depending on what that income looks like, it determines at what tax rate you will be taxed on your income when you file your taxes. If you are looking for a new accountant or any consultations, again, I'm Ashley Fields with Fields Accounting Firm, and I am accepting new clients. In the description here on this video will be a link to my website. And if you have any additional questions, I will love to answer them in the comment section. Okay, until next time.